Welcome to Fundamentals of Buying Your First Home. My name is Larry King. I am a mortgage loan originator with American Eagle. I've been with American Eagle for 6 years, and I've been in the mortgage lending business for over 20 years. The credit union was founded by Pratt & Whitney aircraft employees in 1935, and it evolved into a full-service financial cooperative offering all of the financial products that other financial institutions offer, with the main difference is that we are a cooperative, a nonprofit cooperative. So instead of paying profits to stockholders, we give back the profit to our members. It's a member-owned organization, so in order to do business with American Eagle, you merely have to become a member by establishing by opening a savings account with a minimum deposit of $5, and that establishes your membership for life. So we are a member-owned organization. We've got thousands of members, lots of assets, over 300 employees, and we're headquartered in East Hartford. Oftentimes, persons don't even realize that credit unions are an option for obtaining a mortgage loan. And indeed, American Eagle has been offering mortgage loans since 1992. We funded billions in mortgage loans since that time, and we fund loans through members' deposits. We don't. We are a direct lender, and we fund loans directly from funds that we obtain through members' deposits. As we mentioned earlier, all of our decisions and our processing and underwriting is done in East Hartford, so we're very local, and we have a very experienced team of originators, underwriters, processors, and closers, all housed in our offices in East Hartford. Before I get into the essence of the fundamentals of purchasing your own home, I'd like to take a look at the option of renting versus owning your own home. Oftentimes persons feel that homeownership is not within their reach because they feel they can't afford it. But once you look at some of the numbers here, you may think differently about that. So we have here on this slide an example of renting a home that's valued at $200,000. In this example, we've got a rental payment, a monthly rental payment of $1,500. So if you rent on this home for $1,500, at the end of 12 months, you would have paid your landlord $18,000. If you lived in this house for 30 years and continued to pay $1,500, you would have paid your landlord a total of $540,000. That's over $500,000. You've actually paid for the house almost 3 times over. So at the end of the 30 years, what do you as a tenant have to show for it? You have nothing. At the end of the 30 years, the landlord has had you pay off his house 3 times over, and he's sitting there with an asset that's probably worth more than $200,000. So you've helped him to increase his wealth over the years that you've been paying rent, and you have nothing to show for it. The alternative is to own your own home and to pursue the purchase of owning your own home. The example continues here with a home. Let's say the home that you're purchasing is valued at $200,000. So let's say you purchase the home for $200,000. You obtain a loan of, let's say, $197,000. So at today's interest rate of 3% for 30-year term, we would estimate your total monthly mortgage payment to be about $1,500, the same as the rental payment in the previous slide. So as an owner of a $200,000 property, you're looking at paying virtually the same in rent payment, same as you paid in rent on the other slide. But the main difference is that after 30 years, your home is totally paid off. You now own an asset that's worth at least $200,000, and usually with the increase in value of real estate over time, it's likely to be worth a lot more than the $200,000. So you've been able to build your own wealth and equity by paying a similar amount that you would have paid in rent, where you would end up with nothing. Aside from the accumulation of wealth, the other advantage in owning a home is that you can take advantage of certain tax breaks. Some of the expenses that you pay as a homeowner can be deducted from your expenses. So in essence, you can realize a higher income based on the deductions that you can experience as a homeowner. There are eight key steps in purchasing a home, and these steps are detailed here, and you can see in red that as a lender, the lender is responsible for guiding you through a number of the steps, step 1, 4, 6, and 7. So the important thing is to understand what the steps are, and then to align yourself with the right partners, the right team to assist and guide you through each step of the process. The first step involves the pre-qualification. So you will want to make sure that you identify a lender and engage a lender that can guide you through the pre-qualification process. So as a mortgage loan originator, this is something that I do on a regular basis. And steps involved with the pre-qualification. The end result is that you come out with an amount that you qualify for purchasing a property, and that qualification is usually reduced to a letter that's called a pre-qualification or pre-approval letter that's good for up to 120 days. So the mortgage pre-qualification process involves three key components, and these are the three components that a lender will assess to determine your qualification for a mortgage. The first item that a lender will determine is your, from a credit standpoint, your qualification credit score-wise. When the credit is pulled, there's a three-digit number. Actually, there are three scores, and each score is a three-digit number that reflects your likelihood to pay your bills on time compared to others. The score ranges from 300 to 850, so a low of 300 up to a high of 850. And each of the three bureaus, TransUnion, Equifax, and Experian, issues a three-digit score. So as a lender, we consider the middle of those three scores to be your score. And all loan programs have a minimum credit score, so you need to understand what those minimum scores are, and then we would determine your qualification based on the middle of the three scores. As I said before, the score ranges from 300 as a low to a high of 850. As a first-time home buyer, there are a lot of programs through which you can be approved from a credit standpoint for a score in the marginal range between 585 and 669. The goal that I recommend is to try to achieve a score that's in the good range, 700 to 739. That puts you in a better bargaining position with regards to getting the best loan with the best terms. Once you've identified where your score is, and if it's not quite where you want it to be, it's good to know what you can do and what factors really affect your score. On this chart, you can see that the factor that has the biggest impact on your score is your payment history. That's whether or not you pay your debts on time. So each debt that shows on your credit report will be an indication of what your history has been, whether you're on time or you've had a history of being late. Late payments have a very, very significant impact on your score. I've reviewed credit histories where a 1 month late payment, 30-day late payment on a seemingly insignificant credit card debt has dropped a person's score by up to 50 points. So it's important to maintain timely payment on all the accounts that appear in your credit. The other factor that affects your score is the amount that you owe on your revolving accounts. So any credit card accounts that you have, let's say you have a limit of $1,000, you need to keep the balance below $300 in order for the impact to your credit to be minimal. So those are the two factors that are crucial for achieving or maintaining a strong credit score. The other factors are the length of history. You know, if you've got items on your credit report that you've only had for a short period of time, just a few months, you may not even receive a score. So there needs to be a history for the lender to assess your willingness to pay your debts on a timely basis. So at least 6 to 12 months is the minimum history in order for a score to be generated. Other factors is you need to have a mixture of accounts, installment accounts with fixed payments, along with revolving accounts, and then you want to also protect your credit by not having a lot of inquiries that could also impact your score. But the biggest factors are paying on time and not carrying high balances on your credit cards. The second factor that is assessed in determining your qualification for a mortgage is your income. Your income determines your capability for paying a mortgage. So we want to identify and use to qualify any source of income that's likely to continue for at least 3 years and that can be documented. So we want to see for any job that one has when you work for an employer, pay stubs that cover the most recent 30 days, W-2s for the last 2 years. Sometimes the person self-employed will want to see 2 years of tax returns, federal tax returns. So any source of income we can use as long as it's likely to continue for 3 years and can be documented. We assess the income in order to determine how much of a mortgage you can be approved for. And we do this by coming up with a debt-to-income ratio, which identifies what you earn per month, the total amount of income that you earn per month. And then we don't want the new mortgage payment to consume more than about 33% of that. So in this example, on this slide, the estimated income is $6,000 per month. So 33% of 6,000 is 2,000. So we would not want this borrower to have a mortgage payment that results in a payment more than $2,000 per month. Otherwise, we consider that too high, and statistics show that there's a higher likelihood of default if the payment exceeds about 33% of the gross monthly income. The third factor that's to be considered is having enough money for the down payment for all the costs involved in purchasing a home, which include down payment and closing costs. And we'll go into more detail about closing costs in a little bit. But we need to determine the source of funds that one has to execute the purchase of a home. Again, to cover the minimum down payment and to cover the closing costs. Funds can come from any source, any of these sources, savings, checking, money market accounts, CD accounts, any of those types of accounts where you may have money saved can be used as a source of funds for the purchase. We would need to see statements covering the last 60 days. One can also use retirement funds, any 401k accounts that allow for withdrawal for a home purchase, and a lot of them do. A statement reflecting the amount in that type of account would need to be submitted in order to use those funds. The third source would be potential investments that you may have, whether they're stocks, bonds, or other types of investments that you can access for down payment. That's definitely a source that can be used, and we need statements from that source. The fourth very common source of funds to cover the cost would be gift monies from a blood relative. And gift monies are often given by parents and grandparents and aunts and uncles to assist a borrower, first-time home buyer, in covering the cost to purchase their first home. The fifth item here is a source of funds that we offer at American Eagle to assist first-time home buyers in covering the costs. We have 3 programs that we participate in. One is the Equity Builder program, in which one can obtain up to $15,000 for down payment and closing costs. And these funds can be used for the purchase in any town in Connecticut. The second one is Housing Our Workforce. This is a matching program. So if a borrower puts in up to $10,000, this program will match that $10,000 with an additional $10,000. So if you have $10,000 to put towards the purchase, this program could extend you an additional $10,000, so you have $20,000 available for the purchase. And then the third program is the House Hartford program that can be used exclusively for purchasing in the city of Hartford, maximum of $40,000 for down payment assistance. As I said, just for purchases in the city of Hartford. For all of these programs, there are income limits. So the programs have been designed to assist low to moderate income borrowers. So if you have any interest and feel that you may qualify, get in touch with me and I can assess your qualification for any of these programs. An important part of the process of pursuing homeownership is to understand some of the terms, some of the glossary of terms that you'll hear about as you talk to lenders and realtors about the process of purchasing a home. One of the things I want you to understand are the different components of a mortgage payment. And there are 5 components of a mortgage payment. The initial component would be how much you have to pay on the amount that you're borrowing. So if you're borrowing $100,000 at a rate of 3% for 30 years, your principal and interest payment would be $422. So the principal and interest are combined into one figure. And in the example that I just did, for a loan of $100,000, that principal and interest payment would be $422. The next component would be property taxes. Whatever the taxes are for the property that you're looking to purchase, we would take that annual amount. So if it's $12,000 for taxes for the year, then we would add $1,000 to your monthly payment. Hopefully your taxes won't be that high, but if they were, then $1,000 would be added to your monthly payment to account for taxes. So what we would do with that, each month we would take the $1,000, put it into an escrow account, and then we would pay the taxes out of that escrow account when those taxes from the town become due. And we do a similar thing with homeowners insurance. So whatever the cost is for homeowners insurance, you would obtain that policy, pay for it for the first year, and then you would divide by 12 the annual premium and then add that to your monthly payment. And then lastly, if you put less than 20% down, it would be required that you pay a private mortgage insurance premium. And the amount of that depends on how much you actually put down and what one's credit score is and what the loan amount is. So those are the 5 components of a mortgage payment: principal, interest, which would be one figure, the property taxes, homeowners insurance, and the private mortgage insurance. So those would all be rolled into one payment that you would make to the lender, and then we would handle covering the property taxes and the homeowners insurance and the private mortgage insurance. So those are the components of a mortgage payment. And if you put 20% down, if you have enough money to make a 20% down payment, then the private mortgage insurance would not be part of your monthly payment. You would be able to eliminate that part of the monthly payment. Another important term and form to be aware of is what's called the loan estimate sheet. This is required to be given to you by the federal government. The government says that you have a right to know early on in your discussion with a lender what the fees are, what the rates are. All of the details of a loan needs to be identified in what's called a loan estimate sheet. It's a 2-page document, and it can be used to compare the loan programs that are offered by different lenders. So it's a great tool to use for you to shop around. Another term is the fixed rate mortgage. Fixed rate mortgage is a mortgage where the loan interest rate remains the same for the entire term of the loan. Most mortgages are 30-year mortgages. So if you closed on your loan at a rate of 3% for a fixed 30-year term, then it would stay at 3% for the entire 30-year term. And if it's a $100,000 loan at 3% for 30 years, your payment would be $422 each month for the 30-year term. So with a fixed rate mortgage, there's no worry about varying loan payments. And this is the key difference in renting, because usually when you're renting, the rent's going to go up over a 30-year term. It's almost guaranteed that your rent's going to go up a few times during a period of time such as that. But for a mortgage, that mortgage payment, the loan payment does not vary with a fixed rate loan. The other option to a fixed rate is an adjustable rate mortgage. It's not something that is very popular now, because the fixed rates are so low that it's really not an advantage to consider an adjustable rate. At a different time when the rates are higher, oftentimes the adjustables start out lower, so it might make sense in some scenarios. But for a first-time homebuyer, I would never advise looking at an adjustable rate mortgage. Another term that you'll hear about is the word points. And a point is defined as 1% of the amount that you're borrowing. So if you're borrowing $100,000, 1 point or 1% of $100,000 is $1,000. Oftentimes, lenders will offer you a particular rate, but there are points charged in order to get that rate. So when you're looking at the loan estimate sheet that we talked about in the previous slide, one of the things you want to look for are the fees that are associated with what that lender is offering you. So if they're offering you, a 3.3% interest rate, that's great. But also look at what is it going to cost you? What are the closing costs? What are the points that the lender is possibly charging you to get you that low rate? So points are a point is defined as 1% of the loan amount, and oftentimes additional fees that a lender will charge you with the loan that they're offering. So always look for the points as an additional charge in your loan estimate sheet. The other way that points are used, sometimes a point can be paid in order to lower the interest rate on your loan. So let's say the lender offers you a rate of 3%, but you feel the payment on that is a little too high for your liking, and you'd like the payment to be a little lower. So you could actually pay a point, 1% of the loan amount, to reduce your rate from 3% down to 2.75, which would reduce your monthly payment somewhat. So sometimes borrowers will choose to pay a point in order to reduce their interest rate. The other important factor to consider in purchasing a home that is the need to pay for closing costs. So there are two categories of costs in purchasing a home. There's the down payment, and usually the minimum down payment is at least 3% of the sale price. So if it's a $200,000 property, then the down payment at minimum would be $6,000. The other costs would be closing costs. And closing costs include a lot of items, and some of them are identified here on this slide. They could be the lender's application fee, or oftentimes there's an origination fee where you pay for, handling and processing the application. Again, points would be identified on the loan estimate sheet and would be included in closing costs if the lender's charging points. There are third-party costs that pay for the appraisal, that pay for the credit report, that pay to determine whether the property is in a flood zone, that pay for the escrowing of taxes and insurance. There's an attorney that needs to be paid for the services that they provide for the transaction. There's a need to pay some prepaid interest and to pay for a homeowner's insurance policy up front, to pay up to 6 to 8 months of taxes to put into the escrow account. So there are a number of fees, a number of costs. Oftentimes the closing costs can be more than the down payment, particularly if you're putting down 3%. So it's important to look at that loan estimate sheet to really get a good understanding of the total costs involved in purchasing a home through your preferred lender. So those are some of the basics of the process and what a lender looks for in order to determine how much you qualify for, and then to reduce that into a letter. As a first-time home buyer, there are lots of programs out there, and American Eagle is very proud of our first-time home buyer program. It can be used for purchasing your primary residence. It can't be used to purchase an investment property. The minimum credit score is 620. Minimum down payment is 3% of the sale price. You can do a fixed or adjustable rate mortgage. Fixed would definitely be preferable. Once you submit an application for the loan, you can lock your rate in for a 60-day period so that you have 60 days within which to actually close on the loan and be guaranteed that rate at which you locked. As a first-time home buyer, we'll give you $1,000 to help pay for your closing costs. That's one of the ways the credit union gives back to its membership. Again, we're a direct lender. All of our processing and underwriting is done locally in East Hartford. And this is our first-time home buyer program is a great alternative to a very popular government loan, which is entitled an FHA loan. All the information that we've talked about, there's more detail on that information on our website. I encourage you to visit our website at americaneagle.org to find out more about mortgages, about budgeting. There's some calculation sites where you can calculate your mortgage and just find out more information about what American Eagle can offer you as a first-time home buyer. So the mortgage originator, the lender is where you start with your home buying process. The other parts of your team include the real estate agent, the closing attorney, the home inspector, and your homeowner's insurance agent. So I just want to give you some insight as far as the other members of your team and how to approach building the right team. So the next once you're armed with a pre-qualification letter from the lender, you would want to share that with an agent that you choose to help you find the right home. So in selecting the right agent, you want to identify someone who's experienced and who is a full-time agent, and someone with whom you're comfortable. It's a matter of a rapport, establishing rapport with the right agent. And I say full-time because some agents are part-time, and oftentimes they can't devote the attention, particularly in this market, that's needed to identify and then pursue the available properties. You want someone that's familiar with the target towns that you're interested in considering for living. You want an agent who's experienced as a buyer's agent. Oftentimes agents are focused on being a seller's agent and not so much as a buyer's agent. So you want definitely someone who is experienced and enjoys functioning as a buyer's agent. What the agent will do for you, they'll connect you to the multiple listing service. That's a database that lists all of the homes that are available through the real estate agencies. They'll arrange for attending showings and open houses. They'll assist in drafting an offer and a contract for a particular property that you're looking to pursue. They'll assist in scheduling the home inspection, and they will arrange at the end, they'll arrange for the final walkthrough right before the closing to make sure everything is in order with the house that you're pursuing. As I mentioned, the agent will assist in setting up the home inspection, but it's, you need to really identify the inspector that you're going to rely on to inspect the home for you. So you want to do due diligence and contact several companies to verify the costs and find out what services they provide. You want to make sure that they're certified through American Society of Home Inspectors. ASHIs is a good thing to look for when you're looking for inspectors. They'll include termite, structural, mechanical, environmental, and sometimes radon inspections as part of their inspections. So you want to make sure you understand what will be included from the inspector that you're considering. And if there's a septic system or well water, there may be separate costs for inspecting those items. So make sure you're aware of that. The next part of your team would be the attorney. We have a list of approved attorneys, but you can use any attorney that you want in order to assist you with the purchase. And the attorney basically will review the contract, make sure it provides the right protection for you, and then they'll make sure that any deposit that you give your realtor is protected. Make sure that all the dates are met, that you don't pass any dates and put your deposit at risk. They'll obtain title insurance to protect your ownership interest in the property. They'll make sure that you obtain homeowners insurance, and then they'll handle the closing and disperse funds to the appropriate parties. And then finally, the final part of your team would be the insurance agent. You would want to shop around and find the best policy that you can, and you can use any insurance company that you choose. You want to ask certain questions of the insurance company that you're considering. Will it cover pay to repair or replace? What about your belongings inside the house? Is there coverage for that? Is there coverage for any other structures on your property that may be damaged? And what do they cover if you need to vacate the house during extensive repairs? If you have any other specific needs towards preparing yourself for homeownership, we have some self-paced learning modules. Take about 5 to 6 minutes that are free. So there's more detail for those topics on our website. Again, thank you for participating, and hopefully you found this of value. If you have any questions or wish to pursue an actual pre-qualification, don't hesitate to contact me. Thank you, and have a great day.